Roll call, please, Judy.
Mr. Lekowick?
Present.
Ms. Cavanis?
Here.
Mr. Haschak?
Here.
Ms. Harris?
Here.
Mr. Swope?
Present.
And Chair Land.
Here.
Ms. Covison is absent by prior arrangement.
Okay, I would like to ask Trustee Cavanis to lead us in the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
The Mendocino County Board of Retirement meeting for August 19th, 2026 is called to order at 8:47 a.m. At this time, I'd like to call for any public comment for matters that are not on the agenda. Seeing none. Anything online?
Does not appear there's any public comment at this time.
Okay, that'll move us to item number 1, the consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Are there any requests to pull anything from the consent agenda? The consent agenda is approved by unanimous consent. And that moves us to item number 2, actuarial rate of return assumption review and adoption. Graham Schmidt and Ann Harper, Chiron.
Judy, can you share, does she need permission to share screen, or can she just share?
She logged in?
Yeah.
Yep.
Okay, great, thank you.
Yep.
Good morning. I'm Ann Harper, and I'm here with Graham Schmidt. We are your new actuaries, and before we go through the presentation, I want to say that to thank you for this opportunity to be your actuarial consultant. We are very excited to be here, and we're looking forward to building a very productive relationship with you all, helping you understand risk and achieving your funding goals. And before I pass it on to Graham to introduce himself, I wanted to say that I've already started my relationship with Mendocino County from the last meeting, where I drove back to the Santa Rosa airport and stopped at wineries and actually became a member at Jackson Keys on my way down. So I'm really looking forward to this relationship. And I am in the San Diego office with Chiron. It's actually just north of San Diego in Solana Beach. I don't know if any of you are familiar with that, but that's where I've been with Chiron for almost 20 years now, consulting on public sector.
Thank you, Ann. I'm Graham Schmidt. My history with Mendocino Sarah goes back a little bit further. My first meeting was to deliver an audit, and I know the date. It was January of 2011. I know that because my daughter had just been born a few days before that, and she now has her learner's permit. So that's my relationship with Mendocino Sarah, and again, I've done a few audits for your plan. Really excited to be working with you as your actuary. I'm in our Lafayette office, so right near Oakland, Walnut Creek.
So as you know from the last meeting, you wanted us to come back, or not come back, but wanted another actuary to give you, if you will, a second opinion or a different analysis on your expected investment return assumption. And today we are here to do that. First, we'll go over the economic assumptions just at a very high level and look at some trends. And then walk through the building block approach to these economic assumptions, which I'm sure you've seen before, but we'll just reiterate it briefly. And then we'll dive into the analysis of the investment return assumption and how we go through that. It is a little different than Siegel's, but there are similarities. And then looking at your expected portfolio returns based on a variety of investment consultants' capital market assumptions. So the economic assumptions, price inflation, and then there's wage inflation and the cost of living adjustment, as well as what we're here to talk about is your discount rate. And when we look at the economic assumptions, it's a little different than setting the demographic assumptions, which are really behavior-based of your membership. These are more macro assumptions, and so we do still look at the historical experience and the industry trends, but those are really just to set the context for setting the assumption. What's most important are the plan dynamics, and this is specifically if your plan is an open plan or a closed plan, because then there are very different things that you need to consider, which yours is open. So, and then we also look at the future expectations of what your investment consultants are predicting that your portfolio.
I just wanted to clarify something. You used the term discount rate, but that would be similar or actually is the same as the expected investment return or the assumed rate of return. For people who are listening, because I know we have a couple of people online, they may not be familiar with the term.
Yes, they're synonymous with each other in what and how we value liabilities. Yes, they're the same.
I'm sorry for the interruption.
Yeah, no problem. Okay, and so then we most importantly look at the future expectations, what's going to happen in the future based on the experts, your investment consultant, and other investment consultants as well. And then also the board's risk tolerance or risk preference, meaning what you're comfortable with in terms of how likely you are to achieve your assumed rate of return. And we'll go into that a little bit later. So first here we're looking at the historical asset returns for your system since 2011. The bars represent the returns on the assets. The blue bars are the market value, and you can see that those fluctuate much more than your actuarial value assets, which are the green bars. And that's because the actuarial value of assets are smooth. We do a smoothing technique on them so that there isn't those large fluctuations when we're setting your contribution rates. And you can see that the market value has been greater than the assumed return for all the time periods that we show up there, the 5-year, the 10-year, and the 15-year. The market value average return has been greater than your assumed return. And 9 out of the last 15 years, that market value has been greater than your assumed return. So I don't know that I've seen a system that has done so well, especially given the fact that you have no private equities. And so I just wanted to comment on that it's in those three, the 5-year, 10-year, and 15 years, all above your assumed rate of return.
Thank you.
Trustee Swope has a question.
Could you elaborate a little bit more on the return on an actuarial value? I'd like to, I have some sense for it, but could you elaborate a little bit more?
Sure. So that's a bit confusing sometimes because when just everyone understands like the 5-year smoothing what happens, but when we do the return the actual value of assets, we take whatever it is at the beginning of the year in that actual value of assets, and then we look at your cash flows and we have determined what your value is at the end of the year. And so it's really like we back into that return based on those markers. So it's really the return on those smooth value of assets.
And in some sense, it's a 1-year horizon based on what you're saying.
Right. When we look at it every single year, we'll look at like when we do the valuation this year, we'll look at what the actual value was last year, we calculate what it is this year, and we kind of back into what that return would be to get to that level based on your cash flows too.
Thank you.
So now we're going to look at some industry trends. We do a survey at Chiron of about 40 California systems, all the SACR systems, a lot of the caliper systems as well. And this is showing the distribution of assumed rates of return or discount rates since 2007. And the trend you can see, obviously, is that the discount rates or assumed rates of return have come down over the last 20 years. The yellow dot there is your system, is Mendocino Serra. And you can see at the very last 4 or 5 years that it's overall, the group has tended to be very stable in terms of their discount rates. They've been maybe coming down slightly, but it's just interesting to note too. And you've been at this 6.5% for the last 3 years here. Then this is showing that's the information for 2025. You can see the bubbles just indicate different systems. There's one system down here at 6%. And then the majority of them are right up here around 6.75%, and you're one of these bubbles right in here. It's 6.5, and then looking at it.
What plans are represented there? What's the, who are those? Are those all counties? Are those all Searle
Yes,
counties? Okay.
they're Searle counties, and they're all of the city systems like Fresno, San Diego, San Luis Obispo County, all the
San Francisco,
all the LA city counties, all of those.
all the charter,
Also some
charter city,
California.
charter county plans
Oh,
that are
okay.
not part of Cyril, they're independent of the Cyril, but it also includes statewide plans, is that correct? Like CalPERS and CalSTRS?
Yes,
Yes, so
yes.
it also has some transit systems
Yes.
as well, some independent transit systems.
Oh, okay, so I would think there was a lot more of those. That's why I asked the question.
Right,
Not everybody responds.
Oh, okay.
right.
Gotcha.
And just for clarification, because I was confused about this, that the dot that's highlighted in the previous page slide
Hold on, let me go.
is not our dot. No.
Oh, no, the dot on
Not
that is
one, the
just,
next one.
the dot on that one is the median.
That one, yeah.
That's the 6.75%. So you can see that there's a lot of systems right at that 6.75%, and some above it, maybe a half a dozen to a dozen, and then some below as well. And then if, look at this next slide here. This shows the actual numbers of systems at each of these assumed rates of return. And you have here at the low end, as Graham was saying, this is a transit plan that's closed, so they have a very conservative asset allocation. But most 18 systems are at 6.75%. And I did want to point out that there are 4 systems here that are not, that don't have an assumed rate of return right at that quarter basis point markers or parameters, if you will. There's 2 at 6.625. There's 1 at 6.8, and that's CalPERS. And then there's 1 at 7.2%, and that's San Francisco. So it's not unheard of to have a discount rate that's not right at those 25% markers.
And so I have another kind of question about things that are not unheard of potentially. I've read in articles, and I just kind of wondered if you had seen this or dealt with this, maybe not with folks in California, but are some systems like on the East Coast actually raising their discount rates or considering raising the discount rate?
You know, I've heard that there are some systems who have done that. I believe, and I don't know the state, there's one state system
Washington.
that raised it, but weren't,
State of Washington raised theirs, but that was not a recommendation of their actuary. That was an action by the legislature to deal with budget issues.
Oh, okay. So by people that definitely weren't actuaries.
Yeah, their actuary did not recommend that course of action.
I know there was another system, a state system that raised their discount rate, but they were very, very low. They were at like 6% or something.
One of the New York ones,
Yeah.
I think. I believe one of the New York systems.
I do know that, as I work on this plan, San Jose Police and Fire, they're at 6.625%, and they toyed with the idea of raising their discount rate a few years ago because their capital market assumptions showed that they could earn something like 7 or 7.25. But one of their biggest concerns is that their members are paying like very, very high contribution rates, and so. And the contribution rates for all their members are like yours are tied to that assumed rate of return. So, but they did stay at the 6.625. it's hard to say. That's the only the only drawback, I think, from doing that. Okay, so looking at the building block approach, I'm going to go through this quickly because I know last meeting Siegel went through it as well. But the inflation assumption, the price inflation, is the foundation for all of the other economic assumptions. It's a component of your wage inflation assumption. You add the real wage growth to get that wage inflation assumption, and then your cost of living adjustments are based on the CPI, the inflation, plus you have a West region adjustment on your cost of living adjustments, because on the West Coast here, and what you use for your CPI to determine your cost of living adjustments is traditionally higher than just the average US CPI, so you have a small adjustment there. And then the expected rate of return includes the inflation assumption plus the real return. And that's really what we're here to talk about today. At the last board meeting, the board adopted to keep all of your economic assumptions the same, 2.5 for inflation, 3 for wage inflation, and then that 2.75 for your cost of living adjustment. You also include in that cost of living adjustment any banks that your members may have. We value those banks in when we're determining the liability, because we know that that's there for many of your members. And then, last but not least, is that expected investment return. We know your inflation assumption is 2.5%, so we're here to discuss that real rate of return. Right now, it's at 4%. Siegel had recommended you reduce it to 3.75% so that your assumed rate of return would decrease from 6.5 to 6.25%. And that's when you decided not to adopt Siegel's recommendation and just to get another, a second opinion on this. And that.
Well, we asked for additional analysis, and I just want to clarify because the wording could give a wrong impression.
Okay.
If we had not changed actuaries, we would have asked Siegel for the additional analysis of the return assumption. We really wanted to get more into understanding their use of their systems for the capital market assumptions and the other options out there for the capital market assumptions, which I think you're going to go into in the next couple of slides. Right. But that's the way we would think of it as opposed to a second opinion.
Yeah, go ahead.
Excuse me, if I could just add, yeah, I guess maybe a little sensitive to the term second opinion, in the sense that, you know, we had a new actuary, you know, it is just the timing of it was such that you're actually sitting in the room and you're going to be taking over. And there, you know, there's obviously a little bit of ambiguity and some wiggle room in these numbers. And so I think that it was prudent for this board and consistent with their fiduciary duty to, you know, hear what its new actuary had to say. And so that's, you know, I think some people could take the term second opinion in a different way, and I just wanted to clarify that.
Sure.
So thank you.
Yeah, I apologize for using that term.
Well, and it makes total sense, given
Right.
that we have to sign the next set of reports.
Right, exactly.
So you probably want to know what we think about these assumptions, right?
Thank you.
Okay, so when we analyze the investment return assumption to make a recommendation to the board, we have a similar approach to what Siegel does. We look at your asset allocation, and we look at then the capital market assumptions around each of your asset classes from your investment consultant and other consultants as well to come up with that expected return. So aggressive allocations, like we may support higher assumed return rates, right? We saw in the California surveys how there's a lot of systems that are at 7% or above 7%. But they have a different asset allocations, more aggressive than yours. But with that comes more risk, right? And more volatility in your returns. And so there are only two ways that you can fund your system, right? There's your contributions that are being made to the plan, both for your member and the plan sponsors, and then also your investment returns. So if you're assuming a higher return assumption, then you're expecting then there would be lower contributions. It's that balance, it's that balance. And vice versa. If there is a lower return assumption, you might be expecting higher contributions. But over time, it's important to point out that your assumed rate of return is not really what's going to determine the cost of your benefits. It's really what the actual markets earn over time. So for instance, the last, like I showed you, the last, 10, 15 years with your returns were higher than you assumed. So through those years, in your actuarial process and your funding methods, you've been getting actuarial gains on your assets. And so when you get actuarial gains, that brings the contribution rate down based on your funding policy, and it gradually will reduce your rate. So again, it's the assumed rate of return is really can be looked at is a budgeting issue. And do you want to pay more now or pay more later? Or you're more apt to want to be at a level where you are anticipating your future contributions will either remain the same or maybe decrease over time and not increase.
So if I understand that correctly, then because of that chart that showed that our discount, well, the returns that were coming in were higher than the assumed discount rate,
Right.
so that the contributions were kept low to keep us on the same trajectory.
Right. Well, and it's gradual over time, because when you have actual gains or losses, your funding policy is to amortize those over an 18-year period. So it's a gradual adjustment. Everything we do with pensions is more gradual than it is, immediately. The returns are smoothed in over 5 years, right?
The contribution rates are based on that smoothed return,
Right.
not just the market return.
Right.
And the market return, yes, was higher than the assumed rate 9 out of 15 years, but we're not recognizing all of that. So there could be years where we had a really good return that exceeded our assumed rate of return, but employer contribution rate still may have increased because we were recognizing market losses from prior years in that smoothing period, because we do recognize essentially 20% of the return each year over a 5-year period. So it's kind of rolling.
No, thank you.
Is CalPERS still smooth 17 years? It seems to be they had an outrageously long.
I don't.
They used to have 30. Yeah, it used to be 30, and it used to be a rolling 30, which a rolling 30 meant they were refinancing their mortgage over a 30-year period every year, and they weren't even paying the interest on the mortgage. But they don't do that anymore.
Oh, good.
And that's for their amortization period?
That's for their amortization. They've gone to layered amortization like you have. They actually made a change. Theirs is somewhat different from yours. A few years ago, they adopted level dollar amortization, where you assume when you're paying off these layers of the unfunded liability, you assume that the payment in dollar terms is going to go up as payroll goes up, right? So you're trying for level budgeting as a percentage of compensation. CalPERS has changed so that going forward, at least a few years ago, they stopped doing this. Now they assume those actual payments for each year of the unfunded liability, they don't change. It's the same dollar amount every year.
Which is a little unusual for a closed system, or open system, I mean.
What prompted the, I have seen the light conversion of CalPERS to a more realistic type of framework?
2008.
Yeah.
Everybody realized in the years after 2008, people who didn't have 30-year amortization went to 30-year amortization because the employers just wouldn't have been able to handle it otherwise, right? So not everybody, but many systems did expand. But then they also realized if we use this rolling 30-year period, we will never pay off our debt. When you have such a large unfunded liability, you're not going to pay it off if you have 30-year rolling. If you're fully funded, 30-year rolling is great. It means your contributions are going to be very stable, right? Things happen, paid off over a 30-year infinite period, contributions stay stable. But if you have a really big unfunded liability, that same approach isn't going to work.
So I mean, right now, it seems like we're talking about the overall unfunded liability, but this discussion is not about that. It's about our assumed rate, our discount rate. How do those two, how do we end up talking about the unfunded, the 18-year unfunded liability in the context of this, this decision that we have before us?
So when I had said that the actual contributions are what are going to determine the cost of your plan, right? Or the actual returns?
Yes,
Or
yes.
what are the actual returns?
Over time, the contributions will depend on actual, not expected.
Right,
Yeah.
because over time, if you consistently beat your assumed rate of return, you will get gains, right?
So what
And- right.
if I could, what we are talking about is the overall contribution that the plan sponsor will be required to make going
Right.
forward, of which the discount rate is one factor
Right.
within that. I just
Right.
wanted to make sure that point was clear.
Right.
Well, and the excess schemes go to reduce the unfunded liability, is that right? I mean, in an annual valuation,
Right.
okay.
So, as she said, we do recognize 20% of the actual investment return in that year, and then it's smoothed out over a 5-year period. But whether we actually met our assumed rate causes either a gain or a loss that does get amortized over 18 years in the calculation of our unfunded liability. And I think that's how we got to the discussion about the amortization periods.
Guys, ask us actual questions. We'll happily talk
No,
all day about.
Yeah. We'd rather have the engagement, yes. Makes our job more fun, actually, so. Okay, so looking at this analysis, we collected capital market assumptions from your investment consultant, from Callan. Those expected returns for each asset class, the risk with each asset class, and how those asset classes correlate to each other. These are all given to us by the investment consultants. Siegel, when they presented the results to you in June, they had Callan. They looked also at 7 different investment firms that they work with in some of their 37 Act systems here in California, one of which is Callan is included. And that's how they did their main analysis. They did look at the Horizon Actuarial Services survey, kind of as a side note, but we did look at their capital market assumptions from the 2025 report. The 2026 report is coming out any day now, but we've been looking at the 2025 capital market assumptions from them.
When do you expect the 2026 report data to come out?
I
Any
just
day.
checked, it's not out.
Yeah,
No, but-
Just
any day.
But that would influence the same question we're dealing with today,
Right.
typically it comes out in August.
okay? And when you say it comes out, are you guys putting it out or?
Horizon puts it out on their website. Yeah.
Okay, Horizon's.
Just for clarification, the investment firms, investment consultants like Callan, they come out with their capital market assumptions December, January timeframe. We will receive a report from Callan at our January meeting talking about what they expect the 2027 capital market assumptions to be. Horizon takes those surveys from dozens of different investing consulting firms and managers that set capital market assumptions, and then they put together a survey that sort of does an average of that. They do a 10-year and I think a 20-year or something along those lines. So they're kind of collecting information, and how quickly they collect it and analyze it and put it all together affects the timing of their report, which is why 2026 for Horizon is not available in January like we would have from Callan.
Thank you for clarifying that. I probably asked the wrong question myself. I'm a little bit focused on this triennial study, that it includes, duplicates an old year, the 2022-23 year, I believe.
So with the
Well, and what we're missing that can affect this decision today is what just the fiscal year that just ended. We're doing this.
right, we
early.
can't do it any other way. So when we do our experience study, we're looking at the past 3 years that had concluded and seeing how our actual experience, the number of retirements, the number of deaths, our investment return, et cetera, compared to what we assumed was going to happen, how many people quit and took a refund. So we're using that historical experience of the plan to fine-tune the assumptions we're using going forward for the next 3 years.
I understand that, I believe. But what I'm saying is, because of the timing of the change in actuaries, we were seeking to preserve the historical knowledge of Siegel and get this out early.
It's not early. We're looking at setting assumptions that will be used for the June 30, 26 valuation, because even though June 30 was a couple of months ago, we can't put together the valuation and get all of that compiled in a report presented to the board until November. But we are looking at changing the assumptions to tweak them based on our actual experience for the 3 years ending fiscal year 25, to set those assumptions that will be used in our current valuation for June 30, 26.
That doesn't seem to match the calendar that occurred on our last triennial.
So the
Evaluation.
study went from July 1, 2022 through June 30, 2025 as the 3-year period that was looked at. The experience study before that was for the 3 years prior to that, but the timing is when we look at July 1, 22 through June 30, 25, that we don't get that report until usually around April, May, June. We're a little behind the timing here. We would have expected to get that triennial experience report in let's say April or May of this year, and we didn't have it presented to the board until June. But the timing is not unusual. There has to be that lag because we need the time to collect the data, review back on it to what actually happened to our assumptions, to set assumptions going forward for the next 3 years. And if you have a better way of explaining it, please feel free to jump in.
Well, but what I'm trying to say is this would have normally, I mean, the drop, at the June meeting when this came up, I asked if we were behind and what the deadline was in the government code section 54957.5.
There isn't a deadline in that code section for completing the experience study.
And well, you could do a triennial every year. What I'm saying is the last triennial, I believe, looking at the printout I was given in training, it includes a year that we're using now. Whereas if we had stretched it out, we're now sitting on an experience of 2025, 2026 fiscal year. And what I'm saying is those numbers from our experience in the fiscal year that just ended could be utilized to affect the same decision.
So the last experience report was presented in 2023, but it was for the period July 1, 19 through June 30, 22. And then this one started July 1, 22 through June 30, 25, right?
Yeah, so let me try to say this maybe in a simpler, another way. I think what you're saying is that there's a year lag between when the data for our experience study, which includes fiscal year 23, 24, and 25, but we're going to use the data from those 3 years to set our fiscal year, let's call it 26 valuation report, that we are now doing a year and 6 months, let's just say, afterward. I think that's what you're saying.
I'm just trying to time this because I thought when I heard about this and then it was put on a Friday, information to read on the agenda, I was trying to find the time frame. And this one is July 22 through June 30th is a Siegel study of 2025.
Yes.
The last one I think you gave me in training and the risk assessment based on what they were calling the 2023 occurred in 2024. The changes, I believe, occurred in 2024, and I could be corrected because I'm relying on some of those training documents. What I'm seeing is, I think it was a good attempt to try and use Siegel's 13 or 14 years experience with us and their institutional knowledge and to save money. But I'm not sure the exercise saved us money. It shortened it by a year. The fiscal year that just ended
26.
would have been in a triennial study.
No. However, we do have a typo on our webpage, so if you fix the title of the last experience document, it references the wrong time frame.
Thank you. We will fix that.
But we would like to get through the discussion of the discount rate. So I understand you have questions regarding the timing. And I'd like to
Okay.
take that conversation up with you after the meeting potentially
Okay.
and let Chiron get back to the discussion about the discount rate.
I do want to mention that because we are such a small system, we don't have the luxury like CalPERS of getting more information from other sources and other mortality tables, if I would imagine that, correct?
Yeah, and I do want to make a point that I believe Siegel, when they were looking at experience as well, they don't just look at this last 3 years, they also look at the previous 3 years. And sometimes when we do experiences, we may even go back 9 years and take 9 years worth of experience and look at it to build on it, especially with smaller systems, so there's more credibility in the data.
For example, COVID was a unique, an outlier, and in that experience study, they went back and used a longer period of data because they didn't want to unduly influence an assumption based on a one-off sort of experience that occurred there. So depending on whether it's mortality that we don't have a whole lot of, and it's hard to establish a trend from us, using 6 or 9 years worth of data gives you a better idea of the type of mortality Sarah might experience.
And to some extent, this discussion about timing and what periods we're looking at, that is relevant in terms of the analysis of things like retirement rates and what periods of experience are you capturing. In terms of the discussion that's at hand about the discount rate and the assumed rate of return,
Right.
the period that we're looking back over has no impact on what the recommendations are, because the recommendations in terms of this specific assumption are all based on forward-looking indicators. None of it is based on what did you earn in the last 3 years? Because if we base our assumption on what did you earn in the last 3 years, 12%, 13%, right?
Yeah.
Right. So.
Thank you.
Okay. So analyzing the investment return. We collect the capital market assumptions. We then map them to your asset allocation. And for your system, there is an adjustment of administrative expenses to that assumed rate of return of 30 basis points. I do want to reiterate that there was a discussion brought up at the June meeting where there was an option for you to differently structure your assumed rate of return and actually take that expense assumption and explicitly value it so it's not part of or tied into your assumed rate of return, but the board was pretty adamant that they did not want to take that approach. So we are keeping that adjustment for your expenses in there. And so we modeled your target portfolio using all of these assumptions. And here's really a baseline analysis of what we do and what we did for all of these different consultants. And we're starting here with Callan. And this is the 2026 Callan 10-year capital market assumptions. We have your asset categories on the left side. You have your U.S. equities, large cap, small cap, and mid. The global equities, your fixed income, real estate, and infrastructure. And then there's the target allocation for each of those asset classes. We're looking at the arithmetic return is next, and then the geometric return on those asset classes. And we look at the geometric return because that incorporates a longer time frame, and it incorporates your risk for each of those asset classes. So in summary, your portfolio is expected to return in the next 10 years 7.16%. When you adjust that for your expenses, it's 6.86% based on Callan's capital market assumptions. So now we did the same thing. I call it the Siegel 7. With the Siegel 7 investment consultants, and then the Horizon survey. And on the left is what I just presented to you on the previous slide. These little bubbles are those asset classes, and the size of those bubbles are indicate how much of a allocation goes towards each of those classes. So the bigger the bubble, the more of an allocation. So then Siegel, using their 7 investment consultants, they did the same thing here that I did previously in that slide, showing you what their expected portfolio return would be, and it was 6.36%. And then looking at the Horizon survey, we come up with an expected return here of about 6.5%. Now, revisiting the asset allocation, your target asset allocation, we were alerted that your allocation to the global equities was not all 25% towards the global equity market. There was part of that global equity was the emerging markets. And so 6.75% of that allocation goes to those emerging markets. And when you look at Callan here, you can see the geometric return for both of those asset classes are the same. So this did not impact Callan's expected return assumption at all. However, when you look at the Horizon survey, this is the Horizon survey. On the left is the first asset allocation, and then on the right, you can see that with the emerging market allocation at 6.75% up here, their 10-year return on that asset class is almost 10% compared to the 8.5% of the broader asset class of global equities. So what that did is it increased the expected return using this more detailed asset allocation to 6.57%.
Lenore, go ahead.
Which of the black box components has the most sensitivity?
When you say black box components?
Yeah, I mean, of your build, you build the model with various components.
Right.
And what I'm saying is, which of those components has the greatest sensitivity to changes?
So it's generally going to be commensurate with how much you have allocated to that piece, right? So if you have the largest single allocation is to your fixed income portfolio, right? As of one asset class. So if you had a bigger change in expectations between consultant A and consultant B, and those differences were in that class where you have the most money, that will have the greatest impact overall. But you can also look at, we've got all these separate classes, but a lot of them boil down to one thing, right? Stocks and bonds. And even if fixed income is your biggest single class, most of your allocation are in stocks, whether they're US, large cap, small cap. And we tend to see bigger differences between investment consultants in their expectations on equities than you do on bonds. The expected returns on bonds are pretty easy to figure out what they're going to be. What's the return on a bond, right? What are the yields on bonds? They tend to be pretty well grouped in that area. So while the bond itself, because that's the biggest class, might have the biggest impact, it's also the area where there's generally the least amount of differences. The bigger differences are on equities, and as a whole, when you add up all of your equities, that's where the majority of your allocation is. Did I answer your question?
Yeah, I mean, you got to the nature of the question.
Okay.
It's what was going to tilt more the be more important in building the analysis?
You know, honestly, a lot of it has to do with when you look at all these different investment consultants, how much emphasis are they putting on what's the long-term expectation for stocks been, what's the historical return been, versus what do they think the returns are going to be based on where current prices are. And that's where I've typically seen differences in different investment consultants. You'll notice that Cowen's assumptions are typically a little bit higher than some of the other investment consultants. Having sat through a number of Cowen's presentations, I don't know if Jay has ever been up to here to present how they calculate those. There is some, you know, one of the things taken into account is what has been the return on stocks over the long term? What's that equity risk premium? You've heard that term before? So that goes into their building blocks of how they develop their assumptions about long-term returns. It's one of the components. And then other consultants, they'll still use that, but they may put more emphasis on, well, what's the stock market price today, right? What are the current price to earnings ratios? How expensive is the stock market right now? And if you say, well, we're going to put more emphasis on how expensive the stock market is right now, well, the stock market is pretty expensive right now. Returns have been great for the last few years. So if a consultant is putting more emphasis on that in terms of building their model, they'll have lower expectations for equities right now. Is that?
Oh, yeah, I mean, that gets to the nature of which little tweaks on the black box components.
And I'm sorry, is there anybody sitting from Callan behind me that wants to?
We do adjust our expectations using valuations. We currently have a haircut. Equity returns based on current valuations. So we do use that.
You use part of both, right, for setting your...
We don't say the historic average of the S&P 500 returns 10%. Therefore, our expected return is 7.4.
Right.
We generally use more of a building block approach. So one way to think about it is what's inflation you expect it to be? And then what's the dividend yield of the stock? And then what's the growth rate of the economy? And if you take those three pieces, that should be pretty close to what you think the stock market return is. And then you can back out some sort of valuation component. We don't, so what do you think inflation will be, 2.5? And what's the dividend yield on stocks? 2. What's the growth rate of the economy? 3. Add those up, then you get to 7 pretty quick.
Yeah.
Thank you.
So in this slide, we're looking at the real return, which is assumed rate of return less that inflation component. And that's what we're really here to discuss and for the board to decide on today, is what that real return will be, because you did approve a 2.5% inflation assumption. Your current real return assumption is that 4%. These bubbles represent the real return for the different investment consultants, and all of the different investment consultants are above that 4% when it comes to the real rate of return, except for that compilation of 7 consultants that Siegel uses. And this is on a 10-year time frame. When you're looking at it over a longer term, the Horizon survey does have capital market assumptions on a 20-year time horizon, and that real return is all the way almost up to 4.5%, 4.6% on a real return basis. And then finally here, we put together what the likelihood of achieving both a 6.5% assumption and a 6.25%. We have Callan at the top, and based on a 6.5% assumption, you're going to meet that assumption 51% of the time, and it's a little bit higher for the 6.25%. And all of these surveys that we're looking at the 6.5 and 6.25 puts you above a 50-50 chance of achieving those expected returns. We could not calculate what the Siegel 7 survey was at 6.5% because we didn't have that information. So looking at this and all of the analysis that we've done, we believe that both 6.25 and 6.5 assumed rate of return are reasonable. And in conclusion, we would recommend that the assumed rate of return is between 6.25 and 6.5%, including those end goalposts at 6.25 or 6.5 and anywhere in between. You can see we take a little bit different approach than Siegel. We don't believe that this process is conducive to coming up with a formulaic approach to it. It's much more complex and dynamic. And we wanted to end with the assumption can be reasonable without being a single point estimate that the actuary recommends.
So you can see from the information they provided off of the survey of California plans, there are a number of plans that don't use a quarter point increment in using their or setting their assumed rate of return. Siegel establishes all their clients on quarter point increments. They don't do any recommendation that is not on a quarter point basis. It is certainly reasonable, based on the information provided, to use any assumed rate between the 6.25 and the 6.5, inclusive of both those endpoints, as Ann mentioned, in setting the assumed rate of return for the plan. In part, that should be driven by perhaps your risk tolerances and your perspective in approaching the discount rate. Did you have a comment on that at all? All right. So I think that concluded really the presentation from Ann. We do have obviously time for discussion and for public comment, but
You're using stochastic modeling for, towards the last, achieving the 51%?
Oh, it's not stochastic in the real terms, right? It's
Yeah.
more of a, it's a,
Using a log norm,
Yeah.
solving for the log normal distribution of returns to figure out what those percentiles are. And when I say solve, have your prior actuaries ever used the term the illusion of precision? Okay, so we have estimates in here that say 6.36%, right? And I think that's probably why Siegel, my understanding is that's one of the reasons why they look at, they recommend 6.25 or 6.5 is if you're going in between these numbers, there is this, are we communicating to you that we have any real certainty about what these estimates are? And the answer is no, right? We do not, nor does Callan, like no one would say, we think you're going to earn 6.36% in the next, every year. These are expectations, these are assumptions about the future. So we don't want to imply by making a recommendation of 6 point whatever percent that we think that that's the one and true number, right? These are a way for you to, as Ann said earlier, set this pattern of contributions, and to the extent that you have a lower assumption now, it's front loading some of those expected contributions, right? Maybe increasing the likelihood that costs will go down rather than up in the future.
So with that, as far as actuarial standards, your requirement is that you can accept the decision of the board as long as you find the assumption set is reasonable. And that's a term used in like the actuarial bylaws or whatever you want to call those. But the guidelines that are set for how you perform your work.
Yes.
Okay, so we would require a motion on this, but I think next you're going to go to comment.
Well, we're gonna open up discussion before we get there, but and I thank you for your presentation. You guys are gonna stick around, I assume.
Bye.
This has been one of the most challenging subjects to come before this board while I've been here. And, I have been struggling with how I was going to even open up the conversation once you had made your presentation. It clearly, if you look at 18, it leaves this really in our in our hands here when it says that the assumed both are reasonable. Anything from 6.25 to 6.5. These are reasonable places where we can put this discount rate, and that will take effect starting in 27 when we move, or in. That will take effect in the next period, right?
28.
28.
Fiscal year
yes,
28.
Thank you. Fiscal 28. And so, we've seen a lot of information here. We know that this is projecting forward. We know that rates are that the market has been particularly high right now. We know that within that there is a possibility of a pullback. But we also can look and say, hey, we've been above this. We've been above this amount. What you said, 9 out of 15. That's good, but not fantastic. It's a pretty good batting average. So, I guess I would kind of be just polling for opinions from the board on where they would like to see us move this discussion. Yes.
So I think it might be helpful if I just maybe frame the issue just a little bit. And I wanted to let you know, you've heard the term recommendation, you've heard the term reasonable from the actuary. The Searle Code section that applies states that upon the basis of the recommendation of the actuary, this board will recommend to the Board of Supervisors the changes in the rates. And so the recommendation from Siegel was 6.25, and the recommendation here is 6.25 to 6.5. I will note that, like all these Searle sections, there is some ambiguity. And there's another section that seems to suggest that a board like yours has even more discretion than just the recommendation. And the attorneys for the 37X systems are frankly kind of split on the issue, as long as it's actuarially sound and consistent with actuarial standards. Now, fortunately, in our situation, for you guys to make this decision, you've got recommendations from 6.25, at least from 2, up to 6.5. And so I'm not trying to direct this in any particular way. I just thought it might be helpful to have that background and a little bit of a framework as you have your discussion.
Jeff, can I ask 2 questions? I misquoted the government code section earlier. I was using something else. But you're reading from 31453? Is that the?
Yes.
Okay, and that's what we're operating under just to do this triennial study. And when you mentioned, the second question kind of is back to staff. The effective date, you mentioned 2028. I think Doris mentioned something earlier.
So once we perform evaluation, the contribution rates that are established from that valuation are again delayed 1 year before the employer puts them into effect. So that ties into the date that Robert referenced for fiscal year 27. 28, sorry, because we're in 27 now. So we'll use the June 30 valuation, which is going to start off very shortly here and will be prepared by the end of November, or actually early November. And that report will set rates the employer will put into effect for July 1 of 27, which is fiscal year 28. So there's essentially a 1 year lag between June 30, 26 and the rates that go into effect July 1, 27.
And the 45-day deadline in that code section, basically, prior to the fiscal year, we're way ahead of it, and if that's what we're affecting.
Well, the actuarial assumptions do not go to the Board of Supervisors. The rates that go to the Board of Supervisors are the contribution rates, and those contribution rates will go in January, so they can have time to account for them in their budgeting process and put them into effect for July 1 of '27. So the specific actuarial assumptions are not provided to the Board of Supervisors for ratification. The contribution rates each year are, and this code section sort of discusses rates in general, but it means that it talks about the rate assumption being based upon recommendations of the actuary. That rate assumption is also the contribution rates that are being recommended in each annual valuation, not necessarily the assumed rate of return, because it's the contribution rates that go to the Board of Supervisors.
Right, I understand that, but I read it a little differently as I'm looking at it, and Jeff maybe has an opinion on it, because it mentions, this board shall, at least 45 days prior to the beginning of the succeeding fiscal year, recommend to the Board of Supervisors the changes in the rates of interest, in the rates of contributions of members, and in county and district appropriations as are necessary. Now, we could accept the study and say no changes are necessary, but it sounds like not just the rate of contributions, but what we adopt today, or whenever we choose a interest rate of return, EIR, discount rate, whatever we're calling it.
From past practice, I would say the only thing that's been going to the Board of Supervisors are the annual contribution rates for employees and employers based on the valuation report. And that is provided at least 45 days prior to the start of the fiscal year in which those rates become effective.
But the valuation and what we're adopting, that's part of what goes to the board. I mean, it's not that they can
These
change.
assumptions will get used in the valuation report that will set the rates that will go to the board. So they are sort of baked in there. They do not explicitly go to the board as a separate item or even as part.
I'm just reading this section. I'm not a licensed attorney anymore, so as are necessary. So we could make no changes, or we could rely on the various actuarial opinions and make a change.
The rate of return assumption flows into the valuation study,
Right, I know.
which then flows to the necessary contributions to sustain.
Right.
System.
I think I understand that.
Okay. And of course, I got logged out of my computer. No, that's okay. So I was asking for any opinions that the board might have in regards to where you feel like we should set this rate, because it looks like it is in our, in our decision-making capacity to select something between these two values, or the inclusive of these two values. So let's go with Trustee Haschek.
Okay.
Well, when I look at it and you look back at history, which I know we're supposed to be looking forward, but the history is that the 5-year, the 10-year, and the 15-year have all, our rate of return projections were all below what the rate of returns were by 3%, by 1%, by 1.5%. And so I think it's that illusion of precision sometimes that we get bogged down on. When you look at the charts and like Horizon, since we are invested in the emerging markets, it seems like we need to account for that, and the other Horizon without that is kind of not appropriate. So I would say that, we look at the 4.2%.
Which slide are you on there?
16.
Right.
Page 17, is that?
Horizon with EM. Okay, yes.
Yeah, it's 17 on the computer. Yeah, and so I just think that we should be using what we're doing, right? That makes sense. And then you look at the likelihood of achieving assumption on the next slide, which is 17. And we're looking at the 51% to 53% if we're looking at horizon, or the 20-year, which is 55 to 58. I mean, it just seems like we, taking the 6.5, keeping it where it is, and looking at the spread of where everyone else is, all these other, retirement associations. We would be an outlier pretty much if we went down to 6.25.
We would be at the low end, certainly.
Yeah.
I can't speak to what the other systems do because these assumptions typically get set every third year. Some systems may use 5, but let's say every third year. So when we're looking at the rates that other systems are using, we don't know if they adopted it 3 years ago and they're just about to go through this process and they may end up lowering it. So I wouldn't put a lot of weight into how other systems choose their assumed rate of return because their asset allocation is different than ours. And really, this is supposed to speak to MSERA's asset allocation and what MSERA can expect to return, and how another system is allocated and their assumed rate of return has no bearing on that. In general, capital market assumptions have sort of come down the last couple of years, and our goal is to be sort of forward-looking because we're going to set this assumption for the next 3 years.
Right.
One thing too to keep in mind is that your 6.5 is very similar to many, if not most other systems, 6.75% because of that administrative expense adjustment. So Ann and I work on, we have four other SERL systems that have 6.75 as their discount rate, and all of those use a discount rate that is not net of administrative expenses. They treat that as a separate assumption. So their 6.75 is actually very close to your 6.5.
Right, if you took the 675, subtracted their administrative expense like we do, their assumed rate of return then would be down near 6.5.
So if we normalized everyone to that, then that one scatter plot, which shows us significantly lower than most, we'd actually be closer to the middle.
Well, and one problem with those bumblebee charts, as I would nickname them, is that there's no breakdown as to portfolios, risk, duration, et cetera.
Yeah.
And so it's kind of like, just because everybody else is doing something doesn't mean we jump in there. But I appreciate the reversal on the 0.3 makes me think differently about the 6.75.
And I think in the past, the consultants have said, well, now if you've gotten 51% on the stochastic modeling, that's sort of the break point or where you would have your decision. Since it seems like we're at 6.5% with the 51% likelihood, I feel comfortable in going with leaving it the same, 6.5.
So do
I don't, and I will give you a few reasons why. I agree with John that we should try to represent as closely as possible what the portfolio is, but there's a footnote in, I think it's the Siegel study, that said the estimates on infrastructure were so wildly varying, they used a lower one. And that shows one of the differences. And I also think in training, I think Robert mentioned that Horizon is behind on updating something. Now, I don't know what. I don't remember some of their figures, and maybe it's because it's coming out soon. I don't know.
So let me make two comments. I did not agree with Siegel's approach to using the 7 other consultant metrics, right? That was part of the reason why I asked the questions the way I did at the meeting, which revolved around how many do you think you should have to make a robust estimate? Should there be an average? Should it be a median? There are other issues that I had with their approach, one of which was the way that infrastructure was estimated. So, you know, Siegel's comment was that, but it wasn't actually what that means in normal English when people say that. They didn't use other assumptions for infrastructure because they didn't get any other assumptions, not because there was a wide dispersion, okay?
Okay.
And so I was not a fan of their process for that. I didn't agree with the approach.
Okay.
Which is why we sought the additional analysis to look at more detailed asset allocation, like the use of emerging markets or how infrastructure was treated, or a variety of things, a larger pool of assumptions to create perhaps a more robust estimate of what the capital markets would be.
And going forward, that's something that we're going to do. I can't speak to why in the past we had kept that more simple 5 asset allocation class, asset allocation target. I'm not sure why that never included other asset classes that Callan explicitly models, that other investment consultants explicitly model.
Like small cap domestic or
Yeah.
emerging markets.
But-
So we're going to put that information in reports, I think, going forward.
Yeah, and I think the other, I don't remember exactly, Trustee Lekowick, what my comment was about the horizon
I can't quote it
specifically,
either.
but when you bring that up, I wouldn't be surprised if my comment was more about the time lag, that there's a lag
Okay.
in time between that report being released and all the consultants releasing their data in, let's say, January to March period. You know, I think there's also a reasonable expectation, and we'll figure it out in a couple days, that it is the case that those horizon capital market assumptions are going to tick down a little bit, just as a result of what we know has happened at other consultants' viewpoints over the last year. So I think those numbers will come down a little bit. You know, I think it's less relevant for this discussion, personally, whether those numbers come in a little lower or not. I don't think you need that as a bullet point to check off in order for you to make your choice today. I think there's plenty of evidence to go either way. This is a good report that provides justification for both positions, lowering it or not lowering it. So I think that having updated horizon numbers probably wouldn't provide additional clarity.
What about having the data from the fiscal year that just ended?
I have that. So our, by my estimate, we're going to have a deferred gain of $92 million, which is, you know, quite a bit. And our actuarial return is estimated at 9.86. It's almost 10%
Okay.
on an actuarial smooth basis.
Wow.
Wow, what about your market basis?
Because we're bringing forward deferred gains from the past 2 years
Yeah.
or so. I mean, we've
Still
just been
pretty good.
really lucky.
We only have one layer of deferred
Oh,
gains,
because
which
we-
is $30 million,
we smooshed it all
because we
together,
had
right.
combined the previous 4 periods.
That pesky 2022, huh?
Yeah.
So if those,
So it's a good year, is what I'm
Okay.
saying. It's a very good year.
and
But
my
that-
question would be, these numbers, in the Siegel report, there was, I think at page 8, a summary, and page 73 or 74, there was further explanation of the expected effect on contributions and unfunded actuarial liability that going to 6.25 would have. So if 6.25 is quote reasonable and 6.5 are reasonable and anything in between, let's say in the middle, 6.75, 725.
375.
Excuse me, I'm jumping on it, yes. I'm adding them all together. Siegel actually is right there. It's just that they rounded down the .11, And they're almost at 6 3/8.
That 636, that would be their 50%. And Dan actually mentioned that
Okay.
at 50% confidence is their 636. And they don't feel comfortable just saying it's a coin flip. They want to tilt it a little bit one way or the other. They want to make it a little more likely than less likely to get your heads if you're trying to coin flip for a heads. So that's why they would recommend moving that down that full quarter clip. Now, could it have been 10 basis points or 15 basis points? Yes, it could have been, but that is not the organizational approach that Siegel
Right.
uses.
And I guess I'm coming back to approaches also, whether it's 6.25, 6.5, or right in the middle at 6 3/8. As a board, do we want to be taking bets on that are 51%? I mean, the likelihood of, and so that would lean me towards some number lower than what we're at, whether it's 6.4, 6.3, 6 3/8. That's just my opinion. I think Siegel had been with us, 13 or 14 years. They did a good job. It is what I like your phraseology, illusion of precision. It is not a precise, it's like going out and getting an opinion of any market talking head. But I think theirs has more support than just the broader range. For instance, Horizon, moving it out to a 20-year gets a higher number. I mean, it's how you kind of play with these. Well, the other thing we're missing is the hard estimates. Whatever number we adopt, we kind of know or assume 6.5 won't cause any changes. And I may be wrong on the unfunded part, but I am assuming that's going down. It won't affect any contribution rates if we just stay there. What we don't have are the hard numbers in between Siegel's estimate.
Well, even what Siegel estimated in their experience study that was presented at June, those estimates of what reducing the assumed rate by the quarter basis point were based on the system's valuation at June 30, 25, because we haven't done June 30, 26 yet. So those impacts were likely overstated because of the significant positive investment returns received this year. They were just kind of putting that out there as like, if this had been in effect in June 30 of 25, this would have been the result. You would have seen your unfunded liability increase by $3 million and your contribution rates would have been
which
higher.
got the county worried and the representatives of the employees worried.
But it has no actual bearing because we don't know what the impact is, and it's quite possible that even if we went to 625, the impact would not be as large as what Siegel was estimating based on the June 30, 25 valuation data. If that lower rate had been in effect for that period, you run some very rough guesstimates as far as the impact, I think, didn't you?
Yes.
But really, we don't know all of the actuarial assumptions that go into the valuation, and so what we have is, also probably not we're not actuaries. We're not able to make that estimation, and really we're looking to set a rate that is reasonable to use for the next 3 years based on what we expect to occur with capital market assumptions.
And the last year that we changed it was 2014, fiscal year 2014?
The assumptions?
The interest rate.
3 years ago. We went from 6.75 to 6.5. We've been reducing the actuarial assumed rate of return on assets by 1/4 percentage point or more. Sometimes it was 50 basis points since 2013. Every 3 years it has ticked down.
Right, but
And you actually can see that on the graph.
on that one.
Yep.
This way.
Right,
The reason we have 3 dots, that's gold dot is us, we were at
Get rid of
8%
the
those
bars.
3 years, then it reduced here, we were at
Get rid of all the bars.
eight,
Just leave the dot.
775, 7.5, 7%, 675, 650.
right, and that's been the trend of everybody until recently, at least been relatively flat because of the market gains.
Well, we've also done a bunch of revisions to mortality tables and some of the demographic assumptions. So quite a few things have changed over time, but the system has gradually tightened all assumptions, including the investment return assumption. And that's why somebody who didn't know that might say, hey, your funded status has remained relatively flat or ticked up a little bit.
Or your unfunded liability
Yeah.
has increased, but if you look over that, decade time span, the added to the unfunded liability was the result of assumption changes, being generational mortality, which was very expensive, and changes to the discount rate
Right.
going from 8% to 6.5% over that decade, or slightly more than a decade. That did have an additive effect on how much our unfunded liability was. It caused our unfunded liability to increase because of those tightening of the economic and assumptions used, the demographic assumptions used for the plan.
So, again, I'm still puzzled because I was looking at the 2024, April or March of 2024 risk assessment that dealt with the 2023 3-year or triennial study. Do we have time to include this year's, last fiscal year's data? In
The valuation for 2026 is going to be based in part on the assumptions we adopt here, so we can't wait to get 2026 data because we can't do the valuation without this assumption.
without this assumption for the 2026 valuation? All right.
So, I do want to move this along. I just want to summarize, I think, what we're talking about in the last portion here. If we choose 6.5%, if we stay at 6.5%, our unfunded liability will not grow because of that decision, and in general, our contribution rate will not increase because of the decision. If we move it to 6.25, I don't know what our contribution rate is going to be, but if we move it to 6.25, it will be a higher contribution rate that the county will pay, and our unfunded liability will go up because of that decision. That doesn't mean it's not the right decision, but that's how it breaks down. At 6.5, the rate will be lower than it would be at 6.25.
So that is absolutely true, is
Yeah.
the effect of reducing that assumed rate of return. The impact of how large an impact, it's going to be offset by other actuarial gains or losses, and we don't know what those other actuarial gains or losses would be. Now, we do know we have a deferred return, but we could have all sorts of negative experience associated with pay increases not being as expected, or mortality or other things. We just don't know what other gains or losses are going to have occurred in fiscal year 26 that will ultimately end up flowing through to the unfunded liability, which is used in calculation of the employer contribution rate, along with the investment assumption.
Yes.
But what's before us is deciding what is reasonable for the rate of return.
Correct.
Yes.
We need
Right.
the board to adopt a
That-
rate of return,
That's the bottom line.
and our actuary
absolutely.
recommends anything between 625 and 6.5. They wouldn't go lower than 625 because that would be too conservative, and it would put additional pressure on the contribution rates and cause an unnecessary, say, increase in our unfunded liability, or at least that's the way I look at it. And they wouldn't go higher than 6.5 because of the reduced confidence in achieving something that high.
Trustee
And
Harris?
please feel free to jump in.
No, you're doing great.
I've been on this board now through 3 of these votes, and each time we've reduced our discount rate. 5.25. I move that we continue the 6.5 rate that we have now.
So we have a motion. I was going to go to public comment before
Excuse me.
motions. However, it doesn't matter. We can do it either way. So is there a second to this motion? Okay, so now we have a motion to remain at 6.5%. And I believe that Jeff wanted us to have specific language as it pertained to the motion itself. Do you want to repeat that?
Sure, I would recommend that the motion say, the board adopt a rate of, I guess, 6.5, which is within the range of 6.25 to 6.5% as recommended by Chiron.
Thank you.
Okay, do we need to have her restate that, or can we go
No,
ahead
you're
and
fine.
use that as the language, and they both agree to that? Okay, so at this point, we do have a motion, and I would like to move to public expression, or not public, yeah, public comment, if there is any. We have Patrick, yes? You can come up so people can see you.
Just come up so the
and
microphone
We can hear
catches
you
you.
very well.
Yeah. So Patrick Hickey, Field Representative with SEIU Local 1021. We represent about 700 county employees, and in addition to court employees. And you know, our primary objective and our primary goal in representing our members is to make sure that the pension plan is solvent, is strong, that the money's going to be there, not just today, but 30, 50 years from now, as people cycle through their work careers and want to make sure that that money is available. Based on that and based on everything that was presented today, we feel quite confident that staying the course, that the board keeping its current recommended rate of return is the right decision to make. The potential of reducing the rate of return would have other negative consequences from our perspective, but staying that course, keeping it at the current rate is going to keep the pension system strong and make sure that folks will have that money when they need it when they retire. Thank you.
Thank you. Is there any other public comment? Anybody online?
There are participants, but I don't see any raised hands. If you wish to speak, please raise your hand. No, does not appear to be any public comment.
Okay, is there any board discussion along the lines of the motions that we have before us? Any other discussions, comments?
I'll just say, I think it's reasonable to keep it at the 6.5.
Okay,
I'll only say my last. I think Siegel's right, and I think the more conservative approach, even though it causes a little more contribution, we're going to Solomon splitting the baby and coming in at 6.375 is my illusion of precision. And I think that actually continues your long-term reduction and also continues to reduce and make safe the retirement funds for everybody, to continue on that approach and get the unfunded accrued liability down.
How much effort or how much propriety would it be if the valuation study sort of did at 6.25% return assumption versus 6.5? I, as I say, feel comfortable with 6.5, but I'm wondering, when you did the valuation study, would that be really very feasible to do? And would it be even...
To have them do both?
Yeah, to present both. I mean, sometimes the numbers just roll out by changing one item and they just flow through. So I'm asking the basic sort of question.
We certainly could do the contribution rates based on two different discount rates. It just, I guess it would depend on when we come back in November if you're expecting a full report, because you need to adopt that report at that November meeting, or if we would come back and do a presentation on the valuation with the two different options and then finalize the report afterwards. So I guess it's logistically, I don't know.
I don't
Your
like that
process.
idea. I think that sends the wrong message, and I think it could present confusion.
That's why I said propriety.
Yeah, so I mean, I wouldn't want to necessarily see the board do something like that.
Okay, so I guess what we want to do now is unless there is further discussion on what's in front of us, not what we're going to do in November. Unless there is further discussion, let's call the motion. Judy, if you could take a roll call vote, please.
Mr. Lekowick,
No.
Ms. Cavness,
Yes.
Mr. Haschak,
Yes.
Ms. Harris,
Aye.
and Chair Land.
Aye.
Motion 4-1 passes.
Okay, thank you very much for your presentation. We do want to make some changes to the order in which we're going to take up our next items. We're going to take the items that require a vote up front, and I believe that we have your list here. But before we do that, I think we should take a break, 10-minute break, and then we're going to come back and we're going to be addressing the order that you put here. So 10 minutes, let's come back at 10:30 even.
Me too.
You tell my
I might need a gavel.
Well,
Oh, we have
one of my sons,
Okay, we are back in session.
he says it's my
The memo requesting written consent for the Kane Anderson real estate merger. I explained what's happening in the memo. We've also got Callan here if they want to comment about that, but I laid out what's happening, the merger between aware of over the next few years, assuming you all approve to consent to the merger. So happy to take any additional questions. Or
I have, first question is, for me, is what type of attention or service will Bridgeport give us, or what are they obligated to give us? They're a much bigger company than the company that we agreed, what, 6 months ago, maybe long ago, to do business with.
yeah.
Now we're going to have a completely different culture and a completely, it's not going to be the same people that we dealt with, I don't believe. Or maybe it is.
We will still have communications with the same folks. The question is really, Bridgepoint is wanting to expand their offerings. They didn't offer necessarily real estate before this. And so that's part of their expansion is they've got all this other investment strategies that they can offer their clients. And now they're going to be including real estate. So they're expanding on the one side. On the Kane side, if you ask Kane, they would say, well, we want to sell because we believe that we're going to need additional support operationally for the upcoming, what they would term a super cycle in alternative asset classes. And so that's what they would say. And they say, oh, well, we're going to have access now to this 50-person team from Bridgepoint that's going to help us be able to find funding for this upcoming cycle. That's what Kane would tell you.
Does Steve, does Callan have any input or anything to offer on this sale?
We've been in close contact with Robert throughout the whole announcement, and we've met with the King team several times. And the team has reassured us that it's going to remain autonomous. The real estate team is going to remain intact. Investment professionals, there's incentives to keep senior professionals there, but I think there are a lot of unknowns when there are mergers of this kind, like you mentioned about culture, governance, and preserving retention. So we're going to obviously keep a very close eye on all of that, but we don't have any immediate concerns. It's something that we'll continue to monitor, but we think taking action will be a little premature.
Yes.
You mentioned incentives. Are you able to elaborate a little bit on the incentives?
Yeah, so they have employee agreements, equity ownership, and then there's earn-out provisions as well to try to keep senior leaders happy and stable.
Yes.
Explain to me a super cycle, please. What they're anticipating this merger in anticipation of the super cycle. What is that?
I think there's just growing interest in alternatives in general, especially with real estate, with institutional investors. I think they're just anticipating more flows and interest.
Is it also part of just a general real estate cycle?
I think that too.
Okay.
Yeah.
And it really depends who you talk to. That's kind of something that the managers would say. I don't think that nobody would doubt that we're in a new cycle for real estate, right? The 2022 interest rate changes kind of have revamped the whole valuation process for real estate and buildings. So I don't think anybody doubts that that's the case. Is there going to actually be this, huge growing demand for alternative assets across open-end and closed-end funds? Maybe. We certainly went with Kane for that alternative sector performance and exposure. So that's what we expect to see we'll see what happens. I don't think there's any reason not to agree to the merger at this time, but one of the things that I'm going to watch for is I'm going to watch for asset bloat, and I want to make sure that Kyle Mays, the senior portfolio manager, stays on the team and stays engaged, stays happy. So as long as those two things, Kyle Mays stays, asset bloat doesn't necessarily happen, that's good for us. We just need to wait to see if that is the case.
So I don't believe we really have too much of a choice in this particular matter.
We do. We can say we don't consent, and if enough investors say they don't consent, then that merger won't go through.
And that would be based on our percentage. So,
yeah.
At this point, I mean, unless there's other questions, we should just probably ask for a motion. I'm not seeing. What's that? Oh, okay. Is there any public comment on this item?
There is no public comment?
No public comment. Okay, so I would move that we approve the sale of Kane Anderson to Bridgeport. Bridgeport, right? Bridgepoint.
Second.
We have a motion and a second. Is there any discussion? Nope. So let's go ahead and call the vote. Judy?
Mr. Lekowick?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Ms. Harris?
Aye.
Chair Land?
Aye.
Approved.
Okay, and I believe that will move us, sorry,
That's okay.
to item 5, slightly out of order. And this is pensionable determination of unrepresented elected longevity pay code. Doris Rentschler, Executive Director.
Thank you, Chair Land. The county has created a new pay code to separate the reporting of longevity for the unrepresented elected officials labor group off of the management labor group. And this is really to improve their record keeping. Longevity is pensionable for both PEPRA and pre-PEPRA members. This is just a new longevity pay code to assist the county in proper tracking. So we're looking at a motion to adopt both resolutions.
Yeah, since I'm in the elected class, that I've talked to council and we feel like it's appropriate that I continue to vote on this matter.
Yes.
Oh. Okay, thank you. Is there a motion?
Well, I'll move the
Discussion, public comment.
There is no public comment.
Okay, let's call the vote then, please.
Mr. Lekowick?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Ms. Harris?
Aye.
Let's try it.
Chair Land?
Aye.
Approved.
Okay, so now it's going to be really challenging.
Item 6 first.
Oh, we have an item 6. Okay. Oh, this is board policy review. Okay. Doris Rentschler, board policy review. Doris Rentschler, Executive Director.
Thank you, Chair Land. There are 3 policies that reflect minor updates, some formatting changes, and a couple of minor wording revisions. The board communication policy, the portable electronic device policy, and the administrative hearing policy. So we would be looking for a motion to readopt these as the board's review of these policies.
Discussion.
Are these basically tweaking existing policies?
Yes, they have all on a 3-year cycle to be reviewed by the board, and we were just correcting some minor language, formatting, and footer issues with the policies.
I didn't fully analyze these things, and since it's only tweaking, my nitpicking word that I naturally try to do, I'm just going to ignore that for the first two policies, but the third one, my question before you vote it, aye, or vote the amendment. Well, never mind, I'm just going to drop the issue, but my concern is I may already be in violation of this portable electronic device policy because I hate using the 10-year-old iPad.
We're working on that for you. Also, if you have suggested changes, forward them to me and we'll include them in the next revisions. They may not necessarily wait 3 years to come back because we bring them back as other things change that affect the policy. So please feel free to send me your edits. The administrative hearing policy is likely going to come back in the near term after we address some issues with council, but that was going to be delayed probably until we 2.0 Act. So I just wanted to throw that out that these will be coming back, so you're not tied for 3 years to anything you do today. So feel free to send me your proposed wording changes. And we are looking for a motion to adopt either as presented or as amended.
I would move that all three as amended be adopted.
Second.
He said as amended.
Yeah, I think you meant the
I meant not amended.
Okay.
The changes that are in the red text is what I meant.
as presented.
As proposed.
Okay, so discussion? Roll call vote, please, Judy?
Mr. Leckwick?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Ms. Harris?
Aye.
Chair Land?
Aye.
Approved.
Okay, now it's going to be a little awkward. We are going to attempt the closed session item. So we're going to need those who cannot be in the closed session item to exit the room. And what's that? There are two. There are two closed session items. I think we're going to split those though. Well, we can take them both together.
Yeah, you,
Okay.
you decide if they need to be split after you open the closed session.
Okay.
Okay.
Sorry, thank you.
Jeff,
He left.
I haven't read these.
Right, Patrick is
Watching
gone.
from his.
And so that's going to jump us to item 10.
I need to do my report out.
Yes, right, that is, item 10 is the report out of closed session.
On the disability retirement application of Denise Dolly, the non-service connected application, the board voted unanimously to grant that. And on the labor negotiations matter, the board appointed Cabinet to be part of the labor negotiations committee. That's it.
Okay, thank you very much. And that will bring us back to item 3, skipping A. Item 3B, the quarterly investment performance report. That's going to be presented by Callan.
Wonderful. Thank you for having us. It's great to see you. Should I wait for the presentation to come up?
No, sorry.
Oh, no worries.
Just gotta make sure it's still up.
I did not.
Do you
join.
have it up?
I did.
Perfect.
Oh, no. Okay.
Perfect. Thank you, Judy.
Okay.
Okay, and maybe we'll just flip ahead a slide. Oh, there we go. So over the past few months, we've been going through and talking about individual topics to get you ready for an asset liability study. When you went through the consultant RFP search, you heard a bunch of things from other consulting firms and said, hey, have we ever looked at this and have we ever talked about this? So we're just going through clipping off one topic at a time. And so in June and July, we talked about asset allocation by function and talked about direct investing versus fund-to-fund investing. Today, we don't have an educational topic. We'll just cover performance. But when we talk to you in September, we'll talk about liquidity. That's been a question of the committee, or the board, rather. Do we have ample liquidity with the amount of alternatives you have, as well as being in a negative cash flow position? And then active risk budgeting. So that'll be the next topic we talk to you about in September. So let's flip ahead a couple slides and we'll just start talking about second quarter. So before we talk about your portfolio, we always put it in context. Okay, what did the capital markets look like over this one time period? And there are a few themes through the second quarter. The one was the war, energy prices, higher interest rates, the Fed activity, slowing growth. And during the first quarter of the year, that led to negative equity markets. In the second quarter, same trends led to positive equity markets. So it just goes to show you can't time this sort of thing, right? You can't time the markets. You don't know when these things are going to change, because lo and behold, we still have the war in Iran without any sort of ending in sight.
It's not a war.
We have elevated energy prices, we have higher interest rates, and we have slower growth. Lo and behold, you had the S&P 500 up 15% for the quarter, 22% for 1 year ended June. You had the small cap stocks doing even better. And you had international equities doing great. And look at emerging markets. Now, if you dig under the hood within emerging markets, a lot of that is actually these countries that have high exposure in semiconductors. If you look at Taiwan or South Korea, for example, they're really the countries that have been leading the way over this individual time period. When you look at fixed income, positive returns, but not as positive as they could have been because interest rates went up just a little bit during the quarter. A reasonable return over the last 3 years of about 4%, similar to the coupon returns. Real estate is giving you a return pretty close to its income. Not a lot of appreciation added there, but reasonable returns, and it's a nice change in the stabilization over what we've seen over the past few years, where you've had things like traditional retail or central business district office not doing particularly well. So we're starting to see some stabilization in that area. So really strong returns across the board. You know, just a quick side note here, you talked about expected return earlier. And look at the 10-year return and the 25-year return and the 5-year return for the S&P 500. And it kind of shows that there's always this uncertainty even over a time period where people believe there's a full market cycle or a long enough time period for it to be kind of like normalized. 25 years, it's 10%, which is fantastic. 10 years, it's 15%. That's a 5% annualized difference over these time periods. So I really echo the comments earlier about being precisely inaccurate in all of these projections. Let's flip ahead to the next slide and maybe talk, okay, what's going on in the economy in general? Yes.
I'm wondering if you could comment on both the spot silver and spot gold, and seemingly, I guess they're in oil versus gold versus the metals. So could you elaborate a little bit on that dynamic?
I'd say one theme with all of those is they're all kind of linked to the dollar, and you know, gold, if you think the dollar is going to devalue over time or inflation is going to be high and so devalue in real terms, a lot of people have been interested in gold for that reason. You see, gold actually had a pretty miserable quarter, but longer time periods, it's truly astonishing, an 11% return over the last 25 years. These gold cycles tend to be incredibly long. And part of it has to also do, you know, dovetailing with oil is the perception of inflation. Which of these assets are going to do well if inflation remains stubbornly high? So there's this whole category of real assets out there. You would throw oil into that. You'd also throw infrastructure and real estate into that bucket too. You know, things that should appreciate in value if inflation remains stubbornly high. And unfortunately, they have remained stubbornly high. You know, inflation is above the Fed's target, even though the very last reading past this report looked a little bit better. But inflation, if you look on this chart here, I mean, it's still running well north of the Fed's target. Right.
You, of course, mentioned the dollar. What do you see the effect of a leaving from the dollar? The countries are dumping some of their bonds. I mean, how is that playing out with the BRICS? Or?
Yeah, so even after this report, you saw that interest rates have been going up. And that's both in the US and globally. And part of that is, well, I don't want to hold these bonds, US dollar bonds, I'm going to hold something else. Thank you very much. And maybe they want to do that because they think inflation is not going to be contained. And Fed Warsh made some comments, you know, recently that, you know, inflation doesn't appear to be the #1 priority. They might let it run a little hot. So people are selling U.S. 30-year treasuries. And the 30-year treasury yield is the highest it's been in 25 years. And that's not good for the U.S. Budget. I think the interest on the U.S. budget is, you know, interest is going to be the #1 expense, higher than defense. So that's not great. News today, I haven't read all the details, is the Treasury actually went out and bought long bonds today, or announced they're going to buy long bonds. I haven't read all the details about that, and the yields actually went down. At one point today, they were down 6-7 basis points. So, you know, that's one way to combat that. You go on, you know, the Treasury could try to suppress rates, but you can only do that so much, right? What's the deficit, 40 trillion?
Yeah, and the interest is around $1 trillion.
Yeah, $40 trillion deficit.
Is inflation the only place we're seeing tariffs anymore?
Well, yeah. Tariffs, a lot of things are inflationary, higher oil prices, tariffs, lower supply of labor. Those are all inflationary.
All the way down.
Yeah. So, and so that's why interest rates went up in the quarter, and that's why they're up past the end of the quarter, and they're kind of sticking higher. There will eventually be a cost for us if interest rates stay at this level over time. Market, really strong returns across the board. On the next slide, it was really nice to see small caps perform better than large caps in the quarter and the year, kind of a broadening out. And that's good for you because you have active small cap managers, but you also hold a little bit more small cap than in the broad market. So you'll see your equity portfolio outperform for that reason in the quarter. The growth over the past year has, it's in the equity market, it's been really concentrated in growth areas. And, that has changed the way certain indices are constructed. So if we flip ahead, just a few slides to slide 9, there's this family of indices called the Russell indices, FTSE Russell, and they go through and they rebalance and they define what's a large cap versus a small cap stock or a growth stock versus a value stock over time. And because of the run-up that we've had in certain stocks, some of those indices have become and a lot of change between one index and the other. Now, you've got a passive large cap, so it doesn't affect your large cap too much. But your small cap managers, their indices are changing meaningfully because of these what they call Russell rebalancing. It was such a big change this quarter that they decided to do this more frequently to not have such large changes over time. And so they'll be rebalanced every 2 times a year now and not just 1 time a year.
So what you're saying is the small caps are becoming mid caps?
Yeah.
Straight to large?
Yeah.
And at that point, the managers, are they obligated then to sell those, or they can just hold on to them? I mean, or is the ultimate progression for a small cap to become large cap because they've chosen their stocks so wisely?
Some managers let their winners run, quote unquote, and so they'll hold on to them longer. Others are more benchmark aware and worry about, that's a big bet for my index now. I need to sell that out. You've got 4 small mid-cap managers, and some of them are a little more benchmark aware, and then others, like the Fidelity Fund, they don't care too much about the index. I'm going to buy a good company.
Just out of curiosity, because of course I think still the Dow is in existence, but
yeah,
what necessarily prompts the creation of another large index, like Russell 2000, and then what causes the irrelevance of such type of indices?
Yeah, I mean, that's a great and so there are a few things that go on. One, the market changes, and sometimes innovation, you want to include other digital currency index, for example, right? But if you go back to the Dow, I forget how long the Dow's track record is. It's a quirky index. Stocks, and they're price weighted. They're not market cap weighted. So if the price of a stock is 100 versus 20, the 100 one is 5 times the impact of the Dow as opposed to the one that's priced at 20, even if the market caps are equal. So that's a weird index. That doesn't make sense, but it made sense 100 years ago. And then they started creating other indices. Let's get something that's more representative of the US, and it's the S&P 500. Oh, but what about the small companies not in the S&P 500? Maybe I should have the Russell 2000, or maybe I should look at something that's everything. I've got the Wilshire 5000. What about international stocks? I've got the MSCI index. These indices come out over time when there are additional investments being considered. They're also a business, believe it or not.
I was about to ask about who gets paid for then that type of.
So people like you and I will pay an index provider just for data, or we'll get the data, if it's publicly available, SP 500, you look in the newspaper. Where I think they get real money is derivative trades based on the index. So if you trade a derivative on the Russell 2000 index, that accrues to Russell 2000. Russell, that family of indices is now owned by the London Stock Exchange. The LSE owns that index. So, the combination of trading and index providing, that's their economic interest.
And you can tell that if you go to their website, because they'll give you a little bit of a lot, but once you start trying to dig into what, a full index and this whole process of what's in there and that, it gets much more tedious to try to figure out.
Yeah. Well, maybe we'll flip ahead and start talking about your portfolio. And it's, overall, it's a pretty good story. It's the end of your fiscal year. And Claire's going to run with that.
Sure, so we'll flip to slide 15. First slide in the next section, perfect.
I like that.
Yeah. As Greg mentioned, we are looking at results as of the end of June 30, which is the end of a fiscal year for the investment program here. So the top chart, Jerry, to your point, is one I was thinking about in reviewing this report, because it's a chart that we've included quarter over quarter for a number of years now, and it always seems to look the same up and to the right, which is a good thing, but what continues to change is the scale on the left-hand side. Certainly remarkable to see the growth in this investment program from under 400 million 15 years ago to knocking on $1 billion as of the end of this fiscal year.
When you hit it?
Yeah.
We need to have a party.
Don't jinx us.
Yeah.
That's where I came on the board.
Yeah. So investment returns over the course of the last 15 years have certainly been favorable to the investment program. And if we look at just the last fiscal year, that's what we look at the bottom of the page here. So as of June 30, 25, the program had $793 million in total assets. We experienced investment gains over the last year to the tune of $140 million. We'll see this in future slides, but that actually represents a 17% return for the fiscal year, which is truly remarkable. A net outflow of about $11.5 million in the last year, largely to pay benefits. And then, of course, finishing the fiscal year, June 30th, 2026, at $922.5 million. What I also look at on this page is that net new investment column, just to see where money has flowed among the asset categories that you invest in. Much of this, to Robert's credit, representing disciplined rebalancing and keeping you right on top of your strategic target, recognizing, again, cash needs and movement in the market. Key themes in that net new investment column: rebalancing out of equities and out of infrastructure, which was a little bit overweight. Money flowed into fixed income and into real estate. So that real estate inflow representing the funding of one of your new managers, Kane Anderson. The next page, page 16, is the demonstration of what I just mentioned from a rebalancing front. Your actual asset allocation in broad asset categories as of the end of June 30th is on the left-hand side of the page. Compare that to the pie chart on the right, which is your long-term strategic target, and they are right on top of each other again, speaking to the disciplined rebalancing that Robert maintains. You were a little bit underweight to,
We have a question?
oh,
If we were to still continue our wonderful upward trend, is there something like sometimes a psychological barrier for other people watching us at $1 billion versus you're in small taters at 900 million? Well, I noticed that one of the participants watching was with intelligence as one of the participants. So I'm sort of curious about visibility for observers crossing like $1 billion.
I have an opinion on that. They love watching us anyway.
Yeah.
Even if we're, $500 million, we get the same attention regardless.
Okay.
yeah, no magic flip switch, but
Thank you, Robert.
I'll flip 3 slides ahead to page 19, where we look at the change in assets over just the last quarter. So that was fiscal year, drilling down into the change since March 31st. You can see the bottom row here looks at the total fund. At the end of March, you were about $845.5 million. Remember that represented, or the first quarter of the year, as Greg mentioned, did represent a negative quarter from an investment return perspective, and we saw that more than rebound back here in the second quarter of the year. Investment gains in the second quarter totaling about $79 million in aggregate. $2.5 million left the program to pay benefits, and then again you finished at about $922.5 million. Again, looking at that net new investment column, you can see kind of where dollars changed over the course of the quarter. The one thing I do want to call out in the bottom here under cash is there is a line item for pending trade. Just following up, we did mention this last quarter as well. That was money that flowed to Kane Anderson at the beginning of the quarter. And you can see that in that new portfolio. And then returns on page 20. In the last quarter, the total investment program gained over 9%, so a total return of 9.39% for the quarter, just shy of the benchmark return of 9.61, and for the fiscal year, the total program is up 17.7%, notably outpacing that benchmark return of 16.6. Over the last 10 and 15 years, Greg noted those numbers in the capital market returns. Your program has returned 9.74% annualized over the last 10 years and 8.53% annualized over the last 15. So certainly been a good time to be an investor, and this investment program has clearly benefited from the asset allocation decisions made over time. That top chart, sorry, one last comment there. Those gray distributions, those gray bars, represent a peer group of other public plans. And the blue dot is our return for this investment program. And you can see that versus peers, versus other plans, those returns have fared very well, both over near-term and longer-term time periods, in most cases landing in the top quartile.
Why?
Your program's reliance on public equity has paid off. So I think over the years, as you've gone through your asset liability studies, I think that's something that continues to be looked at. But again, while it has led to some volatility in certain years, it's been a benefit keeping that longer term perspective and staying invested in the market, rebalancing when it's been challenging.
One of the reasons I asked the question of just general why is perhaps we're doing better. Is there any possibility that I know a lot of other plans are in private equity and all that. Are those investment vehicles doing worse and therefore making us look better? And is there anything to learn from that?
And hedge
I
funds.
think, sure. Yeah, I think that definitely plays into it, particularly in the last year. It's paid off to be in public equity, right?
Yeah.
And you can see the width of that distribution in the last year, kind of the range of that gray bar. Some of that is due to the asset categories that other plans have selected.
I think if you look at your investment philosophy, I think it's borne out to be pretty successful where, you spend active risk where the market's inefficient. You don't try to be tactical. You don't chase fads. You believe in risk premium over the long run. And that really works. People who have tilted other places to add complexity, to not believe in a risk premium, they haven't done as well. And so it's really to the credit of the board and of making good long-term decisions for years and years. Well, thank you so much for that, Jerry.
The old shoe.
We work together.
The old shoe.
Yeah.
Page 21 looks at returns for the total fund, but on a fiscal year basis. So here we're looking at 1-year time periods. Here it's the last 5 fiscal years. First thing that I notice on this page is just the absolute returns. So 17.5% in the last fiscal year. I remember a year ago sitting in this room saying 12% was remarkable. We'll see what next year holds. We outpaced it. 2024, almost 10%, 2023, over 8%. And then in 2022, when we did see a pretty significant market decline, it was almost a 10% decline for the program. But in all cases, I think another thing that I continue to track is returns for the total program versus the benchmark. Again, really echoing the philosophy that Greg noted, and some of that playing out in the decisions that have been made in the last 5 and 10 years to really be, mindful of where you're taking active risk, implementing your large cap U.S. equity and, a significant your developed markets international with index funds, and then being selective about, active management where it has the best chance of paying off over time. So those 2 dots tracking pretty closely together, which wasn't always the case in the previous 5 fiscal years. I think there were additional tilts in the portfolio that led to more tracking error versus the total fund benchmark. So those intentions in the decisions made by the board over the last 5 and 7 years, again, really coming through in the results that we're seeing, which is great. Page 23 looks at total fund return versus target, but plotting that in a risk return framework. So returns on the vertical axis, volatility or standard deviation of the program, and benchmark on the horizontal axis. For the last 3 years, and then the ellipse representing that peer group again, the distribution of returns for the peer group. For the last 3 years, what you can see is the blue dot is just straight above the green dot, which means you've experienced a similar amount of volatility as the target, but achieved a better return. So that's exactly what we want to see. And then over the last 15 years, outpacing the target, but with a higher level of standard deviation. And I think, again, over that longer time period, we've seen those dots come inside the circle and move closer together again because of the decisions made by the board in the last 5 years to implement with more passive management and then be more selective about active risk implementation. So again, everything kind of moving exactly how intended. I'm pleased to see that pay off over time. The last page I'll point to is slide 24, one ahead, and here we just break down, what has driven from an asset category perspective the outperformance or underperformance of the program versus the benchmark in the last quarter. That's what we see in the top half of the page, and then the last fiscal year is the bottom half of the page. So in the recent quarter, you did underperform slightly. In the last year, outperformed by over 1%. In both cases, all of that really being driven by your active management. And in the case of domestic equity, overweight to small cap, or domestic and international equity, overweight to small cap in those asset categories. But again, Robert's disciplined rebalancing keeps that asset allocation effect very close to zero, and it's really your active implementation that's driving the outperformance in the last fiscal year. I'll pause there. Any questions?
Yeah. We saw a lot, I know over the last, since I got on the board, small caps have been a problem, and you've said to stick with it. And then they had a great quarter. Is there any reason to suspect that that great quarter is an anomaly, or do we expect maybe those small caps will continue? I know that that's asking you to predict the future.
Yeah, we still believe in the risk premium. We think that, if you look over a long time horizon, the overweight to small cap does make sense. That's something that we'll look at again. But yeah, I think it still makes sense.
I mean, do we know what's driving that?
What drove small caps strong
great quarter,
performance?
yeah.
It was a lot of information technology. I think it was for the Russell 2000, IT stocks alone were up 56%, and semiconductors were up 104%. So a lot of
Okay.
Yeah,
So semiconductors, which brings me to my next question, which was the emerging market versus chips. So I think that we also saw a big gain in emerging markets.
Mm-hmm.
And then I've learned, I mean, my perception of an emerging market would not necessarily be a chip manufacturer company, because those are mature companies, even if they're in immature markets or, jurisdictions. So if we're trying to capture emerging market, does it make sense to be in companies, emerging market companies that are buying a lot of chips, where we would capture that with our foreign stocks, I would assume?
Yeah, so emerging versus developed is, originally that was defined by per capita GDP. So how much money does the average person in a country make? And that defined emerging markets. There are other overlays that other definitions might look at, like, what's the, integration with the rest of the world economy, that sort of thing. But kind of like GDP per capita tends to be the number one criteria. And lo and behold, that includes places like South Korea. Like South Korea, it's not in the IFA index. So the developed market index. So if you want exposure to that country, you need to be in the emerging market index. And the same applies to China and Taiwan, massive companies, massive countries, massive economies, but they happen to be categorized as emerging market in part, at least in legacy, because of a per capita GDP basis. Now, do you want to own the biggest companies in those countries? Yeah, probably so. Do you want the Baidus of the world, or SK Hynix? So that's a chip producer in Korea. I mean, the returns are like, I 200% return over what time period? Yeah, that's how we get exposure to those countries. I don't know if that was a little rambling. I don't know if it answered your question.
It's actually right on the money.
Yeah.
Because I was wondering if we had overlap there. Same chip companies from two different vectors, and it sounds to me like you're saying no.
No. So you've got an index fund in the developed market, and so that doesn't have Korea. They're permeating across the globe right now, whether it's Intel doing well, or SK Hynix doing well, or NVIDIA chips doing well, or Taiwan Semiconductor doing well. Those are all like one little ecosystem right now, and it's so it's affecting all of them.
You weren't going to say it's bubbly. You were not going to say
No.
Well, so I'd throw out this visual image that you can maybe use to think about this also is there's a handful of companies that are spending a lot of money that are based in the US, the hyperscalers, the Magnificent Seven, and they're having to spend so much money And all that money is trickling down to the next tier of folks that are helping build out that infrastructure. And that filters down to the next tier that's helping fill out the software and operational components of the things that they're trying to build. And that just continues to spread out throughout the global economy. So, you know, I think part of the understanding for why are small caps doing better, part of that is that trickle down effect of that spending from some of these major folks. You know, the EM, we had artists in here a month ago, and they talked about the concentration in their market, and specifically South Korea and the 3 companies that are driving that return. Those companies are having a flood of cash coming in to their business as a result of the people like Microsoft, Meta, Google spending on all this AI infrastructure. Watching that flow of funds from those, you know, top 5 or 10 companies that are spending money globally.
What we call the Magnificent Seven have done really, really well.
Yeah.
And now they are buying things from the Russell 2000.
Oh yeah, yeah, absolutely. Yeah, network switches. I mean, all of the hardware that the IT people charge us for in the enterprise expense, internal expense fund, stuff like that, but at the global level.
Just a quick one. What about the fact that we gave our highest technology chips to China and they copy everything? Is that going to start to destroy this very delicate balance we have now between what we're doing in this country, what we're having to import, and the lack of utilization of the bill that was under Biden administration to give us money to have more of these chips built in the U.S.? Has that all just disappeared?
Yeah, I don't know. It's really hard to tell, but I do think one thing that we is the ability to disrupt some companies in the U.S. that have done really well with new emerging technology in China, if they're using, you know, our technology or borrowing our AI models or, you know, whatever it might be. I don't know if you remember, was it beginning of this AI model that came out and people were like, oh, they could replicate what we do. Yeah. And actually there was a big sell-off in response to it. And so, you know, there is that risk out there. We should be very mindful of it, for sure.
Crudely maybe dicing it, but memory chips versus microprocessor versus AI chips, what is the approximate generations life for some of those type of items?
That's a level of precision I don't know. Yeah, I don't know.
They're very short.
Yeah.
Yeah, they're short. In fact, that's the huge criticism of some of the federal policies on depreciation now, because these things are, they're so fast that the market changes so fast that they become obsolete. So, you know, to answer your question, they're fast, they vary, and, you know, what's the expectation for the future? Hard to say, but that's part of why I keep saying people have to be aware of the spending of these companies. And you know, recently Google just had to go out to the debt markets finally because they can't fund the CapEx out of their free cash flow, which is fine, but it's just something to be aware of, that they're now tapping debt markets. You know,
Thank you.
So on the next slide, Claire walked through total fund performance, but I can spend a little bit more time on the individual managers. Shows each asset class bucket with its respective index and then the total fund at the bottom of the page. As Claire mentioned, for the last quarter, we're up 9.4%, but did slightly underperform the benchmark at 9.6. really strong absolute returns, but on a relative basis, the key drivers were really, in a positive way, domestic equity. So having that overweight to small cap was really beneficial. Your small cap managers together were up 23% for the quarter, and really led by AllianceBernstein, which is a small cap growth manager, and that was up 30% for the quarter. A theme that we saw throughout all asset classes was growth outperforming value. So when international equity, your value managers underperformed, but your growth managers outperformed. The majority of your international equity bucket is passively implemented, so about 63% in an index, and then having that dedicated allocation international small cap and emerging markets. Emerging markets were definitely a bright spot for the quarter, but again, really led by growth. So having allocations to those semiconductors really paid off this quarter. But if you look at returns in July, the managers that underperformed in Q2 outperformed sharply in July, which shows you kind of can't hold, every investment can't outperform in every type of environment, and that's why we have a diversified. Yeah, key theme was really growth outperforming value for your managers, and we saw that reverse in July. But for fixed income, strong returns, both Dodge & Cox and PIMCO outperformed, and then infrastructure and real estate continue to be additive over the short and intermediate long term. And for the year, really strong return. I want to point that out again, up 17.7% for the last year, with almost all of your asset classes outperforming, international about in line. But really strong equity markets, fixed income markets, and alternatives have done really well. Yeah. Unless there's any questions on individual managers, happy to go deeper. But overall, it's a really
thank you.
good story.
For a great quarter. And we do expect the next one to be even
Better.
We'll try our best.
This is the standard that you set. So thank you very much. Does that conclude item 3B?
And I have
And C?
Sorry.
Do you need help out?
No, I can get there. I'm just not very fast at going from one position to the next.
Thank you.
Thank you
Thank you very much.
for a great
for
meeting.
making it through.
Yeah, much appreciated.
Thanks for
Have a
being
good
here.
safe
It's good to see you.
drive.
No, I mean, that was 45 minutes, so that's perfect.
Yep. Okay, so thank you very much. And
Okay.
that, I believe.
Thank you.
Thank you.
Great to
also
see you.
for adjusting.
No problem.
All right.
Good to see you.
Thank you.
Thank you.
Thanks.
Thank you.
Have a great lunch. It's lunchtime.
All right, so that will bring us rapidly to 3D, quarterly real estate update. Robert Hillis.
I do just want to mention that we no longer have a quorum, but I'm comfortable that we continue with informational stuff, and we're kind of at the tail end anyway.
Yeah.
So, I'll leave it at that.
I
There are some attorneys who would say,
think,
we're done the meeting, but I'm not uncomfortable proceeding.
I think we'll have Catherine back. I think she's just escorting.
Right, but we
through.
still won't have a quorum once Jerry
Oh,
leaves.
okay, okay.
We also have our public website down, so
I didn't
if you
know
do
that.
want to retrieve the items, you probably have to
Wait,
go. Public website?
Oh, public sites down?
Yeah.
Okay.
I got a message while I was here. If you do need to
The
follow
public can no
along.
longer watch.
No.
No,
They can't see the information.
just the website is down. The county's website is down.
Yeah.
Oh, okay.
But we broadcast on YouTube.
Perfect.
As a hyperscaler, YouTube's never going down.
We won't go there.
I'm just joking. Maybe they will.
Okay, so without a quorum, continuing with item 3D, quarterly real estate update.
Trustees, you have the quarterly real estate update and memo. 3D and 3E, we compare those together. I provide a few different updates related to the strategies. One thing I'd like to call out on the real estate update is that we did get signed up With LaSalle, we did make a $6 million commitment. So we've got about $10 million in outstanding real estate commitments due at this time. So we're on track to get within 50 or 60 basis points, hopefully by the end of the year, within our strategic asset allocations. So that's a good thing. I don't have any other comments. And it's an informational only update.
Any questions? Kane update? Any questions on the real estate portion? Seeing none, moving on to item 3E, quarterly infrastructure. And that's also Robert Ravelis.
So 3E is you have the memos, provide an overview of the two managers, and you can read the memos. I'd be happy to answer any questions you have.
Just a note that those aren't available to us right now.
They are if you go to the. That is still up.
If you don't have it bookmarked, you can't get to SharePoint, can you? Because the
Do
link,
you want to see it? I can pull it up.
Yeah.
Do you want the infrastructure? Or
the website is down, so if you click on it, it's going to return you a thing that says can't load
sorry.
this.
Yes, you're
And
correct.
I can't get to the page to load the SharePoint because
I can, however, so
Oh,
should be able to.
But trustees have already read that document. We're just talking about it now,
Okay.
if there's a question.
If I can read through it, I do have it up, but I don't think we want me to read this. That would be long. Did you have any notes on it that you wanted, any pointers?
No.
On,
No, it's just an informational update about, what the two strategies are doing, how they performed through the year, which was very good. So I don't. have
in
anything
general,
else to
the
add.
sector has performed very well for us, correct?
Yeah.
9 to 10%, 11 per
Mhm.
year,
Mhm.
correct?
Mm-hmm. Yeah.
So yeah, following the narrative are the typical graphs that Robert provides that shows the holdings by geographic region or sector in both of those infrastructure funds. So that had been a request from a couple of years back to kind of get a little more detail on what they were holding. But that report comes forward every quarter.
So this is the link. We can use this.
Oh, there, I got it back now.
Well, we could have also picked it up off of our share drive.
Yeah,
I think we're
that's
good.
where I'm going, but it
Yeah,
wouldn't
this is
allow
the
me to
share drive.
access it earlier. So,
I don't think there's anything that stands out a whole lot as changing on the infrastructure side. I think as long as trustees are sort of aware that in the higher inflation environment, infrastructure tends to perform better because of those contractual obligations that a lot of their operating agreements have with local governments or the regulating bodies. Right, that allows, as inflation goes up, that allows them to pass through additional costs that result in us having additional income and slightly higher.
Okay, I guess we'll move ahead then. Well, we did get this up.
we did get this out.
Okay, that'll move us to item 3F.
Okay.
This would be for July.
Trustees, you have the monthly flash report there. On page 2, you can see that we funded some additional money over to Kane, additional $1 million. So we've got, we're pretty close to target at this point, so that's a good thing. And there's really not a whole lot of other rebalancing happening during the month of July. The total returns for the public equity and fixed income was down a little bit, about 0.25%, or 24 basis points. So happy to answer any questions if you have any.
Yeah, what was down? It was domestic equities.
Yep.
Okay.
That's the biggest effect, even though it's only down 6 basis points there.
Right.
AB also gave back quite a bit. There was another high CPI print. The energy was still spiking at this time, and Fed Chair Warsh remains aloof in his comments to the public that are certainly creating some confusion within the market participant arena, let's say.
Who would have guessed?
But I think that's the new environment. Well, it'd be interesting to see if he sticks to that.
Infrastructure did well. And
Yeah.
okay. Questions, comments? I honestly don't know where, okay, 4. So moving on, our next item will be item 4, fiscal year 25-26, fourth quarter budget update.
Trustees, you have the fourth quarter preliminary budget update. We came in under budget. There weren't too many big surprises, as is typical in those memos. I call out the major changes within any given line item and try to provide the reasoning for why those numbers are higher or lower and stand out on the report.
Nothing stood out when I looked it over, particularly?
Yeah, I mean, I think we had a pretty stable year. I don't know if Doris had any additional comments related to that. We, came in under budget and be under budget, so that was not a surprise. If we thought we were not able to cover that with funds from another line item within the budget category, we would bring a budget amendment to the board.
You'd hear about it before fiscal year end.
Yeah. Done with the fiscal year 26 transactions. We're preparing for finalizing those numbers for the audit and for the actuary. And so we will still be providing a final update. I'm expecting at the next month's meeting, we'll have a final budget update. It's going to change very little. It's probably going to have maybe $10,000 or $12,000 more dollars in it compared to this report. So very, very minor, relatively speaking.
Are there any questions, comments on the budget presentation? All right, that will move us forward. That was 4, we've done 5, we have done 6. Brings us straight to the administrative report, item 7, Doris Rentschler, Executive Director.
Thank you, Chair Land. So the big news, of course, is that we do have an election coming up for the general member 3rd seat, the retired member 8th seat, and the retired member alternate seat 10. So we have a calendar and timeline for the election as part of the packet. If you have any questions, I'm happy to review that with you. The declaration of candidacy essentially opens today or tomorrow, with declarations due no later than September 11th. If an election is necessary, it will be held on November 16th.
And so you anticipate the forms being available today or tomorrow?
I believe
I asked Octavio to print them.
They'll be on the website, and then we can also provide them if someone needed, but we will have links on the website. There are 2 California Supreme Court cases that I wanted to give you an update on the Ventura County Employees Retirement Association versus the Criminal Justice Attorneys Association of Ventura County. They had a court case going on regarding the treatment of vacation cash outs, where the payments kind of straddle fiscal or calendar years in the development of the final average salary. This was related to the Alameda case, I believe, that we had gone through during our correction project, and we were glad to see that the Supreme Court upheld the Sarah's application of how they handled the treatment of straddling years in order to pick up additional vacation cash outs, which is to exclude, because that's how Sarah had treated it, and we didn't want to have to go back and make any additional corrections. So this did show that the Retirement Association could make those decisions in alignment with the Alameda decision on how to include or exclude, but it resolved that issue on straddle. You had a question?
Yeah, from Jeff, what sort of was the break or make or break part of this case?
The V. Sarah decision?
Yeah, the plenary authority.
That's a different case.
That's the other case.
We haven't got there yet.
So on the next case, it was La Serra versus LA County. That one was the case on whether or not the retirement system has plenary authority to determine compensation and classification of positions. The appellate court had sided with La Serra, and the Supreme Court, in a split 4-3 decision, reversed that and went back to the lower trial court, saying that really it's a collaborative process between the county and the retirement systems because we are county employees, and it rejected the thought that the constitutional amendment change a few years ago gave the system's plenary authority over everything. It would narrow the focus of that authority over to administration and investments. I'm sure Jeff has some additional comments that he'd like to add.
I do. Can you, is that the end of the summary there?
Yes, this is
It goes to page 2.
right. And
I do have it up here if you need.
that should be your wording exactly.
Yeah. I just want to make sure it was. And I'm a little hesitant even to get into it today because we don't have a quorum, and I think it's such an important decision. There are a few comments I'd like to make about it, and I'm thinking I'm going to hold it over till next month.
Okay, we can bring it back and talk about it next
Thank
month.
you.
Okay.
The last item is, or the last couple of items, Sackers updates. The fall conference is going to be held November 10th to the 13th. If you have not already let Judy know whether or not you wish to attend, please let her know immediately. That way we can release a couple of rooms we're holding if we have folks who are not planning to attend. We're going to release those rooms by Friday, August 28th at the latest, so please let her know if you have not already done so. There is also a legislative update attached to the report that had to do with the bills currently moving through the state legislature. We've talked about several of those in the past, so I won't go into that unless you have specific questions on anything.
Are there any questions? Okay, well, that concludes item 7, which brings us to general board discussion, item number 8. The only thing I wanted to bring up in this general board discussion is that we need to make sure that we have a practice, and I can assist with this if it's required, of exercising the broadcast equipment on the week of a meeting, because the county does push updates to software. These are not optional. We cannot not do this. Okay, so we have to push these out. They're security based. And if the computers that are required to run the meeting have not been started and been allowed to update, then they're going to do that when we come in. And some of them are long. Today was long. It delayed the start of the meeting. So all we need to do is turn on those computers on Monday and pretend like we're having a meeting, make sure things come on, let it do its updates, and then shut it down. And then we should be okay. So if you can add that to your pre-agenda process.
I mean, I would say, I would request, and I don't know if you're the right person to make this request too, but maybe having the IT person do that is a better idea than having us do that.
It's,
I don't know.
it doesn't matter which one does it, as long as it's done. Of course, IT will charge you for that.
So if we just turn it on, it'll do the updating prior to the login. It's not like we have to
Yeah.
log into the system, correct?
In most cases, I believe so, but I would turn it on and start a meeting and pretend like you're firing it up. Because we've had failures with the microphones. We've had to troubleshoot microphones.
Thing is, we don't know how to use that equipment
Okay.
as far as the
I'll talk it over
microphones or
with
the
Scott,
cameras or
and
whatever. We can turn it on and let it boot,
we
and
can
that's as
build
much
a-
as we can do.
We can build a checklist then.
All right.
Yeah, we'll build a checklist. And if we do need to come out, we will.
Maybe it can be done remote.
Yeah,
And
maybe.
Yeah. So we'll just try to prevent that from happening again. That was my only general board discussion item. Anyone else? No? Okay, well, that is the end of item 8, and we have already completed item 9 and 10, and that brings us straight to item 11, adjournment and notice of next Board of Retirement meeting. The next Board of Retirement meeting will be held in the Board of Retirement Conference Room, 625B Kings Court, Ukiah, California, on Wednesday, September 16th, 2026 at 8:30 a.m. Thank you very much.
Thank you. I will send you those resolutions for signature later today.